Good evening, everyone. Thank you for being here. Today, we'll be diving into a smarter way to manage your mortgage, how to pay off debt without sacrificing investment growth. I'm Martine Perron, founder of Art Mortgage and a Smith Maneuver certified mortgage broker. I specialize in wealth building strategy for homeowners. And I'm joined today by Dan Cathcart, an expert in finance strategies. Dan, please introduce yourself.
So I'm Dan Cathcart, a financial advisor. I've been doing this for 21 years now and specialize in a little more advanced strategies around tax planning and wealth building for my clients.
Thank you. Our goal is simple. We want to help you optimize your finance by making your money work harder for you. Let's start by discussing some of the common questions homeowners just like yourself are asking. Am I missing an opportunity to make my saving work harder for me? How can I align my savings and my debt payment to maximize my financial goals? Am I leaving money on the table by not exploring smarter debt repayment strategy? Can I pay off my mortgage faster while still preparing for retirement? How can I ensure my money is working as hard as I am? When I usually talk with homeowners, the three main concern that comes or priorities is, hey, I want to pay off my debt faster. I want to improve my monthly cash flow, and I want to grow my investment. I'm curious if the people here are thinking the same thing. Is your money working hard enough? And what do I mean by that? Most of us already know what investing means. When we do so, the money is working hard because the interest is compounding. And there's a power to that. And Dan, feel free to add if you want during the presentation. But most of us know the power of compounding. Yeah, did you know that when you're a homeowner and that you have a mortgage on your principal residence, there's two additional ways to make the same money working for you? That instead of working one time, it could be working 3 times. Well, let's take a closer look at the traditional approach many Canadians follow when managing their mortgage and investment. I'm sure you've heard of this before. Hey, pay off your mortgage first and then you can start investing. Or being debt-free is the key to financial security. I'm sure, Dan, you hear that as well.
Yeah, I do.
But let's challenge this idea for a moment. What do you think would happen if you wait until your mortgage is paid off before investing? When you don't make your mortgage payment, obviously the bank is going to call you and say, hey, you didn't make your mortgage payment. What's going on? And should we start foreclosing? But if you don't invest, and especially if you're not working with someone that's helping you invest the money, nobody's going to be calling you, hey, are you saving for retirement? And so what if there's a way that you can build wealth while paying off your mortgage? And what if your debt repayment strategy actually help you grow your investment? Would you like to see how the debt swap strategy could change the game?
Oh, I would.
Yeah, the Smith maneuver and debt swap strategy. So I've been doing a couple of webinars in the past about the Smith maneuver, and there's a lot of strategies within it. And one of them, one of my favorite one, is the debt swap strategy. And what we do is we convert the bad debt into a good debt. And what does that mean? It means that the debt is now tax deductible. No extra money is required. We're just restructuring what is already there and the money that you already have. The debt swap, for example, you're a homeowner, you already have a mortgage. The mortgage balance is $400,000. The interest is at 3%. Wow, that's a really good rate. And you have $10,000 that is sitting there in cash. Maybe it's emergency funds, maybe it's just cash in your bank account, and it's not really working for you. Well, the debt swap is that you use that money that's already there, available, and you apply it to your mortgage and you reinvest right away through your line of credit, which means that you have now a debt that is tax deductible. And so on the picture, it means that you take the 10,000 that was available here, put it on your mortgage, reduce the mortgage balance by 10,000 right away, take the line of credit, take that $10,000 back and reinvest it. And so now, instead of having a $400,000 mortgage and 10,000 savings, you having a $390,000 mortgage, 10,000 on your line of credit, 10,000 saved. Why would you do that? Because you have $1 that's working 3 different ways. So we didn't add to the debt, we converted the debt. This might be hard to see on the Zoom, but this would be the amortization for someone that wouldn't do anything. And just by doing that 10,000, nothing more, the person is saving on amortization. They're paying the mortgage faster by one payment. Now, this maneuver is more than that. This is like very simple example, but because we used the $10,000 from the line of credit to reinvest, that interest that was paid through the line of credit, it's tax deductible. So not only these homeowners are saving on mortgage amortization, they're paying their mortgage faster, but they also have tax deduction and saving working for them. If they take that tax deduction that they're getting years after years and then put it on a lump sum of their mortgage, they will even pay this mortgage faster. So this is only the effect of prepaying the mortgage by 10,000, but there's way more to it. You pay off your mortgage by taking the 10,000 that was available, boom, you reduce the interest paid overall here. That's not tax deductible, but because we want you to keep saving money and grow money, you take the money that's now available in your line of credit and you invest it. Would you rather pay interest that benefit the bank or interest that benefit your tax strategy? How would you feel if your mortgage balance would drop instantly by $10,000? Dan, I will let you jump in on this graph.
So this graph is looking at, you're in the situation, you have your mortgage, but you don't have any extra money. And you're wondering, well, how do I make things work in my favor instead of just in the bank? Well, every time you make a payment to your mortgage, some of it's interest, some of it is principal. So what we do is we set up your mortgage so that your principal payment, when you pay down the mortgage, becomes available on your line of credit. It's re-advancing. So when you make your $2,000 mortgage payment or whatever the amount is, $3,000, say $500 was principal. Well, you make your regular payment and then that $500 becomes available on the line of credit and you borrow it and invest it. So this is making your mortgage work to your benefit instead of just the bank's, right? We're going to not change anything you're doing. You're going to make the same payment, but we're going to take the principal and reinvest it. So overall, your debt never changes. This yellow line, that's your total debt over time. The green line is your traditional mortgage and how it would go down over time with payments. But what we're going to do is instead of when it's paid down, we're going to increase the line of credit, which is the purple line. So now the purple line's going up as the green line's going down. And because the debt you have on the line of credit, we borrowed it to invest, it's tax deductible. So if we take those tax deductions and apply them to the mortgage, the blue line would be how much sooner the mortgage gets paid off. Mind you, you're not changing your payments, you're just using the tax deductions you create by investing, and you'll pay off the mortgage 4 years sooner just by doing that. So it's the same payment, all the mortgage is gone, and you have a fully tax deductible debt now. So at year 21, 22 there, you owe the same debt, but it's all tax deductible. So every time you make a payment, you get a tax deduction. But because we're taking that money and investing it, the pink line is your investment portfolio over time. And you can see the Smith maneuver doing it this way. It's a slow and steady strategy. I kind of highlighted year 15 in that box to kind of show, you've been doing this for 15 years and it doesn't really look like super amazing. Your investment portfolio is almost 300,000. Your deductible debt's about 237 and your mortgage is down to 215, 212-ish, that range. And that looks kind of great, but you fast forward 10 years and the investment balance is now closer to about 800 and some thousand, and you still owe that same 450. So at that point, if you chose to, you could completely pay off your mortgage and still have about $400,000 in investments. And that's without changing your payments. And that's how you make the money work harder for you. And that's the best part about this strategy is option A, which everyone is doing, 25 years later, you have a paid off mortgage and that's it. Option B with the Smith maneuver, you have a paid off mortgage and basically as much investments as your mortgage was to begin with after you pay it off. So it just puts you in a much better financial position without costing you more money, right? Just by changing the way you're doing things and making it work to your advantage. And that's the beauty of this strategy and why I know Martine and myself like it so much. I really like optimizing things when it comes to finance. And this is optimization because we're not really changing. We're not asking for anything. We're just going to do it a little better and come out far ahead.
That's right. Thank you, Dan. Anyone that's a homeowner in Canada with a mortgage on the principal residence that can qualify for this product type can beneficiate from the Smith maneuver with no extra money. They can get these types of results by just paying the mortgage they already committed to, but making it work it for them. So eventually you'll still be debt free, but you'll have money saved for your retirement without having to actually take more money out. And we can expedite this strategy if there's actually more money that we can save.
There's a lot of way to make this look even better by looking at your whole picture and then further optimizing.
Yeah, this is the basic maneuver that even if you don't have extra cash, even if you have no emergency fund that you can do as a lump sum, you would still beneficiate from the strategy. So who can benefit from this? Well, you have to be a homeowner with a mortgage on your property with a little bit of equity to make it work. You want to be someone that believes in long-term strategies. This is not short-term. It's investment that needs to grow over time. And it's not just about the interest rate. We want to be able to see further than that and wanted to know the strategies to pay off the mortgage faster. How do you get started? Well, the first step is to explore if this is the right strategy for you. And we can do a free consultation to figure out, first of all, if you qualify and if this is right for you. It's not for everybody because you do need a risk tolerance for working your mortgage. We also need to make sure that you pre-qualify for the mortgage amount that we're working with. And once you pre-qualify, then we choose the right mortgage product, the right lender, the right strategy, and we handle the full implementation. So you have an easy transition.
Yeah, I think what's important if you're interested in this is to talk to us and build a team around it, because Martine's mortgage broker makes sure that you get into the right product. I'm an advisor, make sure your investments are working. You want your accountant on board as well. And there's a few people on your team you want to make this work well for you. So it's important to build your team.
Yes. And I'm going to stop sharing now so we can see better. This strategy has been around since the 80s, and a lot of people might know or heard of it. I thought I knew what the Smith maneuver was until I actually got certified and did the course and understood the strategies. It's way more than what I thought or heard about it. And it's really hard for me right now to do a mortgage. That's just normal when I see so much potential with every homeowners that I talk to. But I would stress the importance of talking to someone that's certified, a mortgage broker, wealth advisor that's certified, because then not all the products would be a good investment if you're doing this type of strategy.
No,
right?
of course not. We got a plan and it's got to be done properly, executed safely. We're doing it long term. We need to be in something we can count on.
That's right. And that's why I think it's really important to work with people like us. We have accountants that are also certified. We basically have a plan for you to make sure that everything is good. Dan, did you want to add anything else, or do you want to add your contact information for maybe in the chat if someone wanted to reach out to you? And
yeah, probably the best way is if I give you my website, all my contact information is there, and it's just www.cathcartfinancial.ca. It's CATHCART financial.ca. I can put that in the chat.
Well, I think that's a wrap for a Thursday night. I don't want to keep people too long, and I'm sure there's other things to do, but thank you so much for joining us. And I'll send more information to the people that I have their emails.
Thanks, Martine.
Thank you, Dan. Have a good evening.